We'll get started now. Good evening, everyone. Welcome to the quarterly con call. We had the last one on the 1st of October, I think just about 2.5 months back. We will get started. As always, Manoj will talk about the developments in the last quarter in the economy, in the markets. And we will talk specifically about what has been our view, impact on our portfolio. There are some concerns on the short-term performance of the portfolio. So we'll cover that. We'll cover how we are seeing various sectors, and we'll also talk about the how the portfolio has done and what is the outlook going forward. Over to you, Manoj.
Yeah, okay. Thanks, Ram. Can we have the slide or should we?
Yeah, we'll have the slides. So I'll just turn it on. It's on, right, Manoj?
Yeah, okay. So let's get started. I think we'll spend some time understanding what's happening around the globe, because what we are reading and what we are experiencing appears to be two different things. So let's, Ram, go to the next slide. Yeah. So today, whatever is happening at the global level is largely driven by what is happening in the US. And that is justifiably so, because the US happens to be the largest economy of the world. Like it or not, a lot of wealth is concentrated in the US. So money movements, capital movements are defined by the scenario that is there in US. So what are we seeing now, and what are we likely to see in future? Now, what has happened over the last few quarters is that with inflation rate refusing to come down in US, and for US, a high inflation is something that they are not used to. So they've been very aggressive in combating inflation with interest rate hikes, and therefore today we see US interest rates at about 4.5%, which is like 15-year high. You know, we've not seen those kind of rates in a very long period of time. And what it does is that it immediately has an impact on growth. See, there is always a trade-off between inflation and growth. So if you are targeting growth, then you'll have to live with a little bit of inflation. And if you are targeting inflation, then you'll have to compromise on growth. But what has happened in the US economy is that while growth has significantly got impacted, and technically, I've been saying this, technically US should have declared a recession, because the technical definition of recession is that 2 continuous quarters of negative growth, which US has already experienced. However, there are some other criteria, and that has never happened. They didn't declare a recession. But now US economy has registered a small increase of about 2.9% in GDP growth. So there is this conflict between containing inflation and managing growth in the US. Given the scenario that is there, apart from growth, you have another major parameter in terms of retail sales, and these retail sales are down. Other indicators are also not very promising. So it will not be a surprise if US officially enters into a recession. And in this scenario, it was widely expected that the central bank will stop short of increasing the rates, interest rates, and in fact, even consider a cut so that the economy is saved from going into recession. However, the recent announcement of the Fed, which says that it will not cut interest rates and it is fine with having interest rates linger over for a longer period at higher rates is something of a dampener for the markets. So because if you see the history, because US didn't have inflation as an issue at any point in time, every time there was a crisis, the solution of the Fed was to simply print more money. And that excess liquidity would act as a magic pill, and the money goes into stock markets and markets go up. Everybody feels that everybody is wealthy and the GDP increases because there's liquidity, and in a matter of few months things are looking good. COVID also, the same thing happened. There's huge amount of money pumped in by the US. However, today what is happening is US is not able to apply that solution because there is a very high level of inflation. So there is definitely this possibility that we may have the US go into recession without a significant cut in interest rates, and that would be a very difficult situation for the world. And if the US Fed actually goes ahead and increases rates further, in all likelihood the rates will still go up, but the expectation is that they will do it in a tempered way. They'll not go with again aggressive 75 basis point hikes. But even if that happens, even if the interest rates increase at a slower rate also, theoretically the money will flow back into the US. So what we saw earlier, FII money going out and going away from India, and rupee depreciating, etc., not in the same measure, but at a slightly lower measure, there can be a repeat of that issue, because capital will flow out if interest rates are again expected to go higher. So a lot will depend on what the Fed will do, and Fed will obviously be driven by what is in the best interests of the US economy and not necessarily the global economy or a particular economy like India. So we'll have to watch the Fed statements very carefully. They have to do a very fine balancing act. But as investors, we cannot rule out a possibility of money flowing out of India, and then possibility of a rupee depreciating further. While the US...
just to add, the housing scene also in the US seems to be headed for some bumpy ride ahead. So people are forecasting up to a 20% decline in US home prices, and so that is also a factor which is adding to the bullet points. Though we didn't write it out there.
Yeah. That is the effect of increase in interest rates from when interest rates go up, because that is a significant cost of housing. There is a decline in prices. Okay. Moving over to the second largest economy of the world, China has had its own share of problems. Despite being a dictator communist economy, we are seeing protests in China against the continued lockdown, which the government took up as a measure to eliminate COVID, but that obviously is not working. China being a low-cost production country, we've not seen the kind of inflation that the rest of the world is grappling with. So China inflation is in control, but because of lockdowns, because of other factors, the high growth rates that Chinese economy was used to, it would be news if Chinese economy fell below growth rate fell below 10%. But now for continuous quarters, China is recording sub 5% growth rates. Now with the lifting of restrictions on COVID, we will see some improvement in the GDP growth rate of China. There will be global demand that will help in some aspect, but again, China has its own share of issues. So we'll have to wait and watch. But clearly over the last few years, there has been a disenchantment of investors with Chinese economy. China has been unpredictable. China has been flexing its muscles. China is taking up needless conflicts with the US, with India, with rest of the world, and therefore the same amount of exuberance that used to exist with China is unlikely to continue. And therefore companies will continue with their China plus one strategy, and that strategy will be of great help to India. So even if the Chinese economy is improving, and with that there is a possibility of commodity prices cooling down a bit because a lot of supply comes from China. So we might have a beneficial impact of the Chinese economy on India, but we will have to really watch this space, because the biggest problem with China is that nothing is reliable of China. So we look at some numbers, interpret something, and then something totally different happens. So that is about China. Ram, can we move to the next? Now, frankly, rest of the world doesn't matter. The third largest economy, Japan, is in quite a bad shape. It is in recession, and that recession combined with inflation is a very dangerous situation. Current account deficit has shot up. Government debt to GDP has got up. So Japanese economy is not looking great. Okay, typically Japan has responded with devaluation of its currency in these situations, and that can again trigger a currency war. As it is, the US dollar has appreciated against all the currencies, so we might see further impact on the exchange rates. But otherwise, we will not have too much of an issue with respect to what is happening in the Japanese economy, because this is something that it's kind of normal for Japan to report very low or negative growth rates. Europe has been completely, post the Ukraine-Russia war, Europe is in a state of turmoil. I mean, maybe turmoil is a harsh word, but so much of indecisiveness is there. They don't know what is right and where the economy will go. There are factors which are not in control, such as how severe or how bad the winter is going to be, what are their energy levels, what should they be doing. Economies are actually taking stances which are breaking away from the Eurozone stance. For example, Italy is not very happy with whatever the Eurozone has decided with respect to putting a cap on Russian oil, etc. So we will see a lot of indecisiveness and incoherent action coming from Europe as well as UK. UK also is having its own share of problems. Brexit has not helped. Political instability has not helped. So Europe in itself is a major problem, and to some extent Indian companies which have a lot of business coming from Europe might get negatively impacted in the short run. So Europe or the Eurozone, which was supposed to be an alternative to the US as a bloc, that is unlikely to be happening anytime soon. That takes us to what is happening in India. Now, with all this global gloomy scenario, things appear to be very different in India. Now, we cannot remain totally unscathed from what is happening around the globe, because it is a global market, and we have dependencies, as I just now said, a big our exports have been significantly impacted because of the global slowdown, because all said and done, we compete on price, and with whatever is happening in their domestic economies, there's not much appetite for buying things up. It's because it's discretionary in nature. So we've seen some amount of cut in estimate of GDP growth, whether it is RBI or IMF or World Bank or whosoever. There has been a marginal cut in our estimates of about 20 basis points, 30 basis points. But despite that, we clearly are the fastest growing economy by a margin. If you look at all the large economies, the growth rate that India is clocking is much higher than the others. And that is a silver lining in the global scenario. And eventually, whatever I have spoken to you about with respect to US, Europe, etc., capital chases growth. So ultimately, the money will have to come into India. And there are so many other factors going strong for India that as an investor, even if you're a global investor, you will ultimately see that, okay, this is the place where I have scope to increase my money, then eventually the money will come into India. So we will have our challenges, and particularly because of the noise that is created in the media, etc., we may have a lot of volatility. There can be ups and downs. Markets can swing up and down in very short periods. But end of the day, this is where the growth is, and therefore money will ultimately come into India and markets will keep going up. Okay, and we are seeing these positive signals in the way the RBI has very, very swiftly looked at reducing the rate at which the interest rates are being hiked. From 50 basis point hike, we've done a 35 basis point hike. And although the RBI governor stopped short of saying that we will have a dovish policy or a neutral policy, they are giving a message, a very clear message that, okay, we are not going to tolerate higher levels of inflation. But if we look at what is the RBI policy with respect to inflation, they are okay with a band of 4 to 6%. And as of now, of course, winter, generally we have a low inflation because of reduction in prices of vegetables, etc. But we are currently at 5.88, which is a good thing. But RBI target is 4.5%. So RBI will look at it very closely in terms of what they need to do with interest rates. We don't have to wait for the MPC to make announcements, that every 6 weeks. Interest rates can be increased or decreased any point in time when the RBI feels that such an intervention is necessary. If at all the US Fed continues to increase rates, RBI will be forced to match it so as to protect the rupee from further depreciation. So these are very, very dynamic situations. But going by what the RBI doing, if the RBI felt that the situation in India is not in control, then they would not have cut down on the rate at which the interest rates have been increased. We've just had a 35 basis point increase, although the expectation was of a 50 basis point increase. So thankfully, we have the central bank being very, very alert and active and responsive to the emerging situation. We've had very positive, Ram, can we move to the next slide? So various parameters that we use for checking out on the health of an economy, when it comes to India, most of them are positive. Our current account deficit, although we still have a deficit, but a deficit of about 1.2% is far more healthier than what we were heading at. We were closing, we had crossed 2%. So despite a fall in our exports, current account deficit remains in control. We've had very good tax collection. See, the biggest indicator of the growth in the economy is the tax collection, because ultimately it boils down to money. People will do whatsoever not to pay tax, because tax is something which, there's no immediate direct benefit that you are getting out of it. So if given a choice, nobody wants to pay tax. And yet if your tax collections are increasing and are very buoyant, that means there is a lot of economic activity happening. And this does not take into account the huge unorganized sector that we have. So if the organized sector itself is contributing to good tax collections, as a result of which fiscal deficit is in control, despite increase in government expenditure, then it's a great sign. So that is why, particularly at Jamā Wealth, we've been very, very optimistic or positive or bullish, whatever term you want to use, with respect to Indian economy, because everywhere you see, that is what you get the feeling. I mean, the big fat Indian weddings have actually become fatter. There's far more money that is being spent. The whole economy, you don't see anywhere that, oh, we are facing a liquidity problem, or, there's sluggish growth or any such thing. And that is also getting reflected in the tax collections. Particularly in Q2, when we were analyzing the results, we saw that many companies recorded increase in top line, but had a sluggish bottom line because of increase in material prices, input prices. Now what we are seeing in Q3 and Q4 is that these prices have kind of eased, and therefore with commodity prices coming down, we are likely to see a much better financial performance, both in top line and bottom line terms in Q3 and Q4. Okay. The only concern at this point in time is that the demand is not spreading to the rural areas, but with a good monsoon and a bumper crop, with agriculture again doing well, we should be able to see demand coming from the rural areas also. And reflecting all this is that the money is coming in. As I told you, ultimately the money will have to come in, and this is not that we are telling this today. Even in March, April, when we did this con call, we said that yes, money will go out because there's a war happening, etc. But ultimately, eventually, money will come into India, and that is what is getting reflected in FII inflows over the last 6-7 months. So we very strongly believe in the India story. And not just we, I think eventually the world will believe in the India story. See, for those who have been a part of the markets, who have been watching the markets since the 80s, 90s, etc., you will agree that one small crisis anywhere in the world is sufficient to bring down our markets. Not just the markets, the economy is also heavily impacted because we were so dependent on external factors. Today, over the last 2 years, we've seen a global pandemic where everybody had written off India, that there will be, mountains of dead bodies in India, that kind of a situation. We've had a raging war since February. We've had the US facing unprecedented inflation, as a result of which interest rates are going up. Each one of these crises would be sufficient to simply derail the Indian economy. But markets as well as the economy continues to be resilient. I mean, this is the biggest proof that India has arrived and India will chart its own path. So now the world is looking up to India to not only lead growth, but actually pull the rest of the economies also on the path to growth. So as investors, let's keep the faith, not because we are Indians and we have to be patriotic or we are emotional about it, but simply to ride the growth wave. I mean, at this point in time, stick with your investments, stick with India, and you will see that there will be a huge increase in your investment value or wealth. So Ram, I think with this, I will hand it over to you. Okay. You want to take this, or should I speak about this outlook?
You can continue, Manoj.
Yeah. Okay. So having said all that, now there are obviously a lot of questions with respect to what will happen to the markets, and more specifically, what is happening to the jewel portfolio, a Spark portfolio, etc. At this point in time, I would want to share with everyone in the call that we continue to back our roots and wings philosophy. It is tested very rigorously over a very long period of time, and there's no reason for us to question that philosophy. We are looking for consistency in fundamentals and in our process. We will not compromise just because the portfolio is underperforming. We will not give in to temptation to include stocks or to remove stocks which are not fitting in with our philosophy. So there will be periods where, like we are currently seeing, there will be periods where the portfolio will underperform. We do not have a magic wand. Nobody in this world has that kind of a wand wherein every portfolio, every stock in the portfolio will outperform, or every outperforming stock will be in our portfolio. We will have our hits and misses, but we know that we are true to our philosophy, and this will eventually yield results. We are, end of the day, investing in businesses. So if the business is having a good financial performance, there is a management which is proactively looking at the business and facing the challenges, and the business has a lot of opportunities in the long term, then we would want to stick with that business. Okay, we have some very strong parameters, and every business has to pass the litmus test. Having done that, there can be underperformance with respect to stock price movement, but we should not be worried about it. As long as the business fundamentals are intact, it is meeting our criteria, we will want to stay invested, and we will resist the temptation. Yes, we are hearing every feedback that is coming our way. We respect that, and we try to incorporate that to the extent possible, but not by compromising on what our belief is. So this is what I would want to convey. And Ram, you can probably take over. Next slide. What is the next slide?
Yeah, so I will now talk about the sectors that we are currently exposed to, and cover a little bit about some of these sectors, what our view is. And then we'll obviously take Q&A towards the end. You can just type it in the chat window just to make it more manageable. We've you can just send me a message or type it in the chat and we'll answer it. Some questions have already come. I'll take them. So as Manoj said, our whole approach is to have a diversified portfolio, which meets the criteria that we're largely talking about. There will be some times when a particular stock, when it is already in the portfolio and there could be some slippage in the fundamentals, then what do we do about it? So we generally, prefer to exit or reduce the allocation, or we will keep it under watch for at least 1 or 2 quarters before we pull the trigger on that stock. But other than that, please be rest assured that when we add any stock, we make sure that it meets all the fundamentals, which are fairly rigorous in terms of the roots part, which is ensuring that there's a consistently high return on equity, very low debt, consistently high growth in earnings, and consistently high growth in the top line, which is sales. I will take one specific example at a sector level when I talk about that. So as you can see, our larger exposure is in the BFSI space, which covers one private bank, HDFC Bank, and then it covers about four financials, NBFCs in which are leaders in their respective spaces: consumer finance, housing finance, asset-based finance, gold finance. So this largely, if you see our exposure to finance, we have now tempered it down to nearly under 20%. At one point, we used to have a bit higher. It may again go up, once some of the clouds in the global economy go away and we see more activity. Chemicals, we have definitely increased chemicals steadily over time. And then there is some IT. There is healthcare, which is healthcare pharma companies, and consumer-oriented companies. And then we have few other sectors in which we have picked one stock, from a diversification standpoint, because they meet most of the criteria that we're looking for. Similarly, in Spark, if you see, then Spark, you won't find any financial services company. It's mostly manufacturing oriented and a little bit of technology, IT oriented. Most of the companies that you see are in that space, because that's where a lot of the SMEs are, which are growing and getting an average market cap of about 3,000 crores are in that range. Now I will talk about some of the larger exposures that we have in terms of sectors. And so the first one is banking and finance. There's a lot of text here in this slide, but I'll come to that. The BFIC sector has delivered a 12% revenue CAGR and 33% CAGR in profit over the last 3 years. Depending on how you look at it, I have another image which I want to show you. Let me just bring that in. But basically, what we see is that this trend will continue over time, and the demand for finance, more economic activity will lead to more demand for finance. One question that people typically are asking of late is, look, so many public sector banks have shot up, why have you not picked any company, from the PSU space? That's a standard question. That standard as in I've heard it a few times. So I just wanted to share one infographic with you here, which we just created. And now bringing the sharing on, I have to just add that in. Yeah, this is the one. So as you can see here, now in general, see, it is not that we hate PSUs or anything like that. We do have in Indraprastha Gas, which is a PSU in our portfolio, and that stock we had it in the past also, and now we brought it back, given the improvement in its numbers. Now, this is the entire spread of banks and financial services companies. So what I've done here is I've calculated the 3-year CAGR in sales, the year-on-year CAGR in sales, which is trailing 12-month year-on-year. Okay. And I've also calculated the same thing for 3-year PAT growth and year-on-year PAT growth. And I might as well show you the actual numbers here, which is there in an Excel sheet, which we have. Yeah. So if you see here, these numbers is what I put back in the slide, because I will send you the slides at the end of this. So these numbers are coming from the 3-year, the trailing 12-month sales compared to trailing 12-month sales about 12 quarters back, which is the 3-year sales. And this number, when you see, interestingly, the sales PSU, the sales for private banks has been higher than the top line growth in public bank, 6.4 versus 3%. And year-on-year sales also have been higher. Okay. PAT, the profit after tax, 3 years back, they were all under losses because they were cleaning up their books. A lot of good stuff has happened there, but the point still remains that from a process standpoint, we don't want to pick a company which typically has what you see here on this next slide. The average non-performing assets, net non-performing assets after writing off provisions for public sector banks is 2.63. That's very high in our opinion. And about a year back, it was 3.77. So yes, they have reduced from 3.7 to 2.6, but so have the private sector banks from 2.4 to 1.7. And across the board, you're seeing some cleanup happening in large NB, like for example, in case of housing finance companies, it's gone down further. So my hygiene criteria is that a lending institution that I pick should not have high non-performing assets on a net basis. So here's where most of the public sector banks will not meet it. And yes, momentarily they may have met it, but given the various influences that they operate under, it is not, we're not sure about what's going to happen. So that is one reason why we don't pick it. Secondly, even if you see from a growth standpoint, it's not that they have really outperformed the private banks as such. And more importantly, what you see here from a 3-year basis, there's an aberration because of losses incurred earlier. Even on a year-on-year basis, where a lot of cleanup had already happened, let's say 2-3 years back, even on a year-on-year basis, the PAT growth for public sector banks is still a shade behind what we see for private sector banks. So this is one reason why we typically we are averse to going astray from our philosophy, right? So sharing the slide again now. So this is the data that I wanted to show about the banking sector. Coming to chemicals, in chemicals there has been a significant amount of capex that's been added. When we do the math similar to what we just saw earlier, 16% growth in the capex investments in chemical sector. And Manoj earlier talked about the China plus one factor. So with that happening, with a lot of demand coming in, there are Indian chemical companies are on a land buying spree. They're buying land, they're adding capacity, they're beefing up their product lines, they're adding additional innovative areas, etc., etc. So this sector, we expect it to do well over the coming quarters. And they're already doing well in terms of many of the numbers. So that is the reason why we probably have a higher exposure to chemicals, both in terms of Jewel and the Spark strategies. Information technology, yeah, we have a few stocks. Yes, the situation in the US is pretty dire. What we saw in the last few weeks is probably a relief rally in the US, and the recession threat is real. But see, if everybody talks about recession, it's very likely that it may not happen, or the avalanche of the recession bad news may not hit us as expected on, let's say, Q1 or Q2 of next calendar year. It will be some surprise event which will trigger it, and then there could be a significant crisis in the US. When that happens, what happens to IT? Firstly, Indian IT companies are largely in the services game, and they cater to the entire Fortune 1000, Russell 2000, the entire spectrum of the US and the world economy. So we are not necessarily a pure tech company that is listed in NASDAQ. NASDAQ has a lot of pure tech companies. Your Google, Amazon Web Services contributes most of their profits, right? So it's basically a tech company, and Microsoft, etc., etc. So they have already corrected significantly, almost 40%, but they could get further impacted. Many of the other growth companies, we are all on a Zoom here, right? Zoom stock itself fell by around 80-85% after the peak that it hit during COVID. So they may get hit, But since the Indian IT companies are catering to a lot of non-IT Fortune 100, Fortune 500 companies, the impact may not be as severe over there. Plus, if the wage pressures in the US, all of those play out, then there could be more offshoring to India. And they will unlikely, cut jobs in India as much as they would in their home economy to conserve their capital. So we've seen already attrition rates stabilizing in IT companies in India. IT companies in India still are not able to pull all their employees back to campuses. There's a lot of behavior change that has set in. It will require time, but I think they're still trying to manage. But attrition has stabilized, wage pressures are stabilizing, and we feel that the 12% or the allocation that we have to IT, which is around 16%, is a reasonable allocation. Actually 12% in Jewel. It's a reasonable allocation going forward. The other sector I wanted to talk about is pharma and healthcare. Here again, this sector has underperformed in the recent months. In fact, Feb to May, there was negative growth, because we were just coming out of COVID. A lot of lull was there. But now growth is picking up back in the industry. In November, they clocked a 17% growth. And because a lot of pending surgeries are now being picked up, there's a lot of anti-infection demand which is there, which has kind of zoomed in November. Now that will slowly abate. So growth could further fall. But then another tailwind for this industry is that there are many chronic therapies which have come out of patent expiry, patents have expired. So that could again, add another growth engine. So pharma again is a defensive play, and we have a modest allocation to that, which we'll continue to hold. The other sector is consumer, which is defensive sector. We have a bunch of stocks there. We have Hindustan Lever, we have Asian Paints in paints, electricals, we have Havells, etc. So in durables, we have a few stocks. So this is again a defensive play. When the economy does well, people will buy a lot of these stuff. So these are fundamentally good stocks that, I would any day love to own. Now, if the stock is corrected by 15-20% in the last few months, I don't think we should panic. We should continue to stay invested in good companies. They're structurally sound. They've got high return on equities. Still penetration, if you look at the rural hinterland, India 2, India 3, all of that, it is still relatively low. There's a lot of growth potential ahead. So we love these companies. And as you move into this Spark portfolio strategy that we're running, you'll see that a lot of manufacturing companies also entering into this. India is going to see a manufacturing boom in the coming years. All of you must already know about how much of Apple's manufacturing is moving to India. And Foxconn and others are building, huge hostels, 50-60,000 people hostels in the suburbs of Chennai to house all these manufacturing workforce. Now, when you have a high-tech, top-of-the-line company employing 100,000+ people, it could give a similar effect like what IT did for us, 20-25 years back. It will do to the lower class in India what IT did to the middle class in India, in my view. And that's a huge plus. So there is a lot of manufacturing that you will see in the Spark strategy. And coming back to consumer, yes, a lot of high-cost inventories are getting cleared. When you look at a Havells or a Prestige, a lot of high-cost inventories are getting cleared. And we should see better margins in the future. So this is broadly some of the sectors that we wanted to talk about. And just a couple of slides. This is the Jewel strategy versus Nifty 50 since inception. Actually, this is not TRA. Recently, TRA data, they've stopped giving it publicly. So this is a Nifty comparison. But still, you'll see that from a launch perspective. I mean, because this is a 3-year, you have to stay invested for at least, I would say, 5 years in equities. And if you believe the strategy, you see that we also invest in the same stocks. My request is to hold on and stay invested. There will be ups and downs in the portfolio. In this chart also, you're seeing ups and downs. but over a 3+ year time frame, we have done reasonably well in case of Jewel. And this data is all in our website. In fact, 2017-18, we underperformed Nifty for considerable time, and we did not sugarcoat or hide the data. The data is whatever is there. Though it was a backtest, we kept the data as it is. We didn't want to show artificially higher data because that is how our strategy played out. Coming to Spark, again, off late there has been a correction in the last few weeks, but this again is a volatile portfolio. You will see ups and downs, but still this portfolio since launch has been able to do well versus the BSE small cap index. So that with that, I am going to stop the bhashan that both of us have given, and I will come to any specific questions that that people have asked. So I'll come to some questions which already came to us on WhatsApp, and if there is time permitting, we can take a few more later. Manoj, is that fine? Hello? Manoj, can you hear me? Okay. Yeah, fine. So I think there was a question on the performance. I think we've already added that. We've already addressed that. There was a question on PSU banks picking up momentum in the last 2 quarters. Why are we missing on them? I've already answered that. And see, we don't look at price momentum per se in the Jewel strategy or the Spark strategy. We look at fundamentals. There was one question that came about when are we launching our PMS offering? Yes, we plan to launch a PMS offering. We are in the process of filing for it for clients who want a managed service. But otherwise, we will continue to provide the advisory offering as is. We want to do really well in advisory space in India and be well known for that. And we've built a lot of technology tools, etc., to enable that. So that will continue to be there. But if anybody wants to move to a PMS, that model will also be available, or have both in parallel, that also can be done. And that is basically, so the question was, in PMS, will you launch different offerings? Yes, we will launch different offerings. Right now, Roots and Wings sticks to a philosophy, because that is what we have promised all of you, that we will stick to Roots and Wings. But in a PMS kind of a context, if we are able to operate in a discretionary way, we will be a bit more nimble. We will probably take a bit more aggressive calls on some stocks, because right now in advisory, for us to give uniform experience to all our hundreds of clients in terms of making them execute, making them sync up the contract notes, and if the contract notes don't come on time, then the portfolios will not be matching, and we cannot give the right quantity advices if how much to buy, how much to sell, if the quantities are not matching in our records with what you have. So that has often led to a lot of issues which we've patiently solved. I think my operations team, led by Aditya and others, have been really working hard on that. So yeah, PMS will give us a bit flexibility. We will launch a few strategies based on momentum, based on special situations, etc. when we come there. The other question was, a lot of businesses are doing well in auto like M&M and Maruti. Why aren't we not keeping them? I think the answer is the same. If M&M, while it's doing well, the debt levels are extremely high, and we are very worried about debt levels. So like Manoj said earlier, there will be some stocks which will do well, which we may not pick. I think he said it. He said it in his own way. The stocks, not every stock that we pick may zoom up, or not every stock that zooms up we will pick. But overall, at a portfolio level, we'll manage to do well. Same thing about Muthoot, Divis, Tata Elxsi. I think we did mention in our latest research note that we sent across about these stocks. We did exit Muthoot in the last rebalancing. and
Ram, we exited Manappuram, not
Manappuram, not Muthoot. Yeah. So, Manoj, you want to add anything about these stocks, Divi's or Tata Elxsi?
No, I think we've shared all the information in that research report. So I'll, instead of talking specific stocks, in the interest of time, see, as I said, we are following the roots and wings philosophy. We are not compromising on any of the parameters. We have to look for what is likely to happen in future, what are the plans of the company, what is their execution track record, and therefore how the stock is likely to perform over the coming days, months, weeks, quarters, etc. So we have to take a conscious call on that, and accordingly we are making our decisions. Okay, so idea is that end of the day, the portfolio should deliver value to our investors. Okay, in the process, sometimes despite good fundamentals, the price may not reflect that. Sometimes company prices shoot up, but there may not be enough fundamentals to back it. There can be, we advise an exit, and after that, see, Manappuram is a case in point. We held on to the stock for a very long period of time, but then we had to rationalize our portfolio. So we took the tough call of, between Manappuram and Muthoot, we said we'll exit one stock. Muthoot looked stronger on all fundamental parameters. So finally, we took the call that we will exit Manappuram, but since exit, Manappuram has outperformed Muthoot. So these are factors beyond our control. We stick to the policy, to the process, and we want to ensure that we do our best in selecting the right stocks for you. Ultimately, over a period of time, if the fundamentals are right, if the management is proactive, and the prospects are right, the company will deliver value. Okay, we'll have to be patient with it.
Yeah. So there was another question related to that by Mr. Pandu about Manappuram, Tata Elxsi, Lux, and many exits and the churn. So I think the answer is broadly in the same line. The Tata Elxsi, we definitely reduced our exposure. That was a conscious call we took because the stock became very expensive. In terms of PE was touching 100. So we reduced the double weight allocation to single weight allocation for Tata Elxsi. And we are confident about that stock. It's a fundamentally strong stock, extremely great, good execution, and very a niche player and it's doing well. So we will hold it. Of course, in rebalancing, what happens is once we have a weight for a stock, a weight given, there will be a minor buy or a minor sell, and that is part of the approach and which we explained to you at the beginning. Though this time we tried to moderate that a bit based on feedback that we received. Lux, yeah, we did exit Lux because of the corporate governance issue, and I think it was a good call because right now the stock is still, much lower than when we exited it at. So there will be creative churn, and here, see, we don't have any agenda in terms of churn. We don't have any consideration that we get, more churn and more brokerage. We are a completely zero brokerage, registered investment advisory. So we will never, churn with the interest of making side money or anything like that, because we are not allowed to, and we don't want to do that also. So that's why we've chosen to operate in this model. And most of our clients have come to us because of this, assurance they have that, look, these guys will not have any wrong motivation to churn a stock. So there will be exits, and there will be exits for valid reasons. Another question on
Ram, I want to add here.
Yeah.
See, sometimes what happens in rebalancing, in the churn, you will sell a few stocks, maybe minor quantity, and buy a few stocks, and that is probably looked at as an irritant by some of our investors. But please be mindful that when you are selling it at a slightly higher price, and when you are buying it at a slightly lower price, because that is what is causing the rebalancing. If a stock has corrected significantly, then the price has come down. So on a percentage level, you will need more stock to balance the allocation. So you are essentially buying at a relatively lower price. Similarly, if the stock has gone up compared to your allocation, that is when we sell. So we are selling it at a slightly higher price. So this is not intentional. Neither is our intention to give you a profit or buy it at lower cost, etc. That is not the case. We are doing it as per our process. But the byproduct of the process is that you will actually benefit through this minor churn that we are we are recommending. Having said that, based on the feedback, we have further rationalized it, and this time you will see the churn much more lesser than what was happening earlier.
Yeah, and Lux Industries, I just checked the name again. We exited when the stock was on Jan 25th. And I think since then, the stock is now less than 50% of that level. So, some of the calls will go well. Many will go well. Some may not go well. But I think that I'm very happy that we exited Lux rather than holding on to it saying, Kare Baba, no, we will, as it is, we could not exit it 20 days earlier because rebalancing was anyway due in 20 days. Otherwise, we could have exited 20 days back earlier because there was a corporate governance issue. And we were waiting for the management to do something about that. The other question, Manoj, you may want to take this again, is what is the rationale for entering Blue Dart at 9,500 after it already significantly ran up from 3,800?
See, it looks very repetitive when I say that, but we have a long list of parameters. Okay, we consider, okay, I'll take little time and explain the process so all of you understand that. See, if I'm looking at a company, I'm looking at financials, all of you know that there's tons and tons of data that is available. Okay, it is for the analyst to actually look for the key messages that are coming out of that ocean of data. And even before we launched our Jewel and Spark, we went into this ocean and picked up a few pearls of wisdom and arranged it in our algorithm to say that these are the things that we are going to track. And we are also mindful that every stock will not meet every parameter. So there is a methodology that has been developed and there is a certain cutoff, and every stock will have to meet that cutoff for it to come into the portfolio. And this algorithm runs every time the results are announced. So if a stock is not making it, it is because in some parameter at some point in time, it has missed and it has therefore come below the criteria. Now, to our bad luck, let us say, it has we were discussing Blue Dart, right? So Blue Dart actually met our criteria when the price is already done. What we are consciously avoiding is to look at the price or the valuation and then take a subjective call in terms of, array, this has already run up so high, so should we invest or not? See, that is subjective, and your opinion, my opinion, Ram's opinion might differ. So what we are doing is we are sticking to our philosophy that we've rigorously backtested, which has worked for us for a very long period of time, and therefore having our faith in that philosophy. And if a stock is picked up by the algorithm because it has met all our criteria, then we are going to back up that stock. So in case of Blue Dart, now obviously I will not have everything readily available with me, but we can go back and see why Blue Dart did not meet the criteria a quarter before and why it has met the criteria now. And as I told you earlier, after we have picked up, the stock might correct. That's fine with us because nobody will know what is going to happen in 3 months' time. Okay, and this when I was a student, when we were learning, we were taught that high PE ratios, stock is very expensive, so you should not be investing in stocks. For example, Infosys at that point in time had a PE of 100. And one of my teachers told me that, it is common sense. You don't touch a stock which is having 100 PE. And I thought that is a very wise thing that was told. But then, dynamics change. So if somebody who had picked up Infosys at that time, when the PE was 100, would have made 10x or 12x times the amount of money by picking Infosys even when the PE was 100. So all this is a little subjective and little dynamic. We have to look at in the rest of the context to see what are the growth prospects, and therefore we have evolved from looking at PE to looking at PEG. Okay, so price earnings growth ratio is what we are driven by when we look at valuations. So there are so many criteria that go into picking or not picking a particular stock. Sorry, I've been a little
also, Manoj, Blue Dart, when we added to the portfolio initially on September 6th, it was around 8,790. Next rebalancing, it was 7,300. So if somebody had rebalanced, they would have probably bought in that range. Now again, it is at 7,500 when the last rebalancing started on 8th December. So the beauty of rebalancing is that at every point in time, you will get to buy the stock at lower levels if it falls. And there's a strong reason why that stock is in the portfolio, because of the entire emphasis on logistics and the whole new infrastructure plan, the new logistics program that the Prime Minister launched. And there's a lot of reason, for that to be there. It's fundamentally a strong stock. Yeah, timing either udhar hoga, but rebalancing will steer us eventually. So we have to look at long term. I would say, there is a question on 2 year. I will respond in case there's no time. I will definitely have taken a download of the chat. I will definitely respond by Monday to all the questions. But basically, these are long-term portfolios. We work without any conflict of interest, and there's a strong logic. We've tested our thing. There will be times when the portfolio will not do well. We have to just, equity needs patience. And believe me, any stock that we identify our criteria, you give it a sufficient time frame, it will grow. It will grow better than the index. That's our expectation. So I think that's broadly it. I will, I think we're more than an hour into the call. I think I've covered largely all the questions. And yeah. So there was one question on, the churn is reduced my capital. Yeah, see, when you rebalance, when you sell a stock, if you're booking gains, let's say you start with 100 rupees. In case you're booking gains on the rebalanced stock, and then you reinvest the amount. Let's say you booked the gains of 5 rupees. So your new invested amount in your Demat account will show 105. Similarly, if you have booked a loss of, let's say, 3 rupees, then your new investment amount will show 98 rupees. But see, this will be like I said, the short term, this is how to look. In the long term, you got to keep, give it at some allowance of time and let the portfolio run its course. That's simple math. And that's why in our app also, we show the original invested amount and the current invested amount, which includes the realized gain or loss. All right. Thank you so much. I will definitely, we will circle back. We'll send a link to this video. We'll send the PPT, and we'll look forward to talking to you again in the next interaction. And meanwhile, anyway, we'll be available for any conversations as well. Thank you, everyone.
Thank you. Chalo. Good day, everyone. See you. Bye-bye.